Hi, I am Thandisizo Mahluchana. I'm talking to David Crosoer on our latest investment perspectives, and we're talking about the global happenings when it comes to the economy, as well as local happenings. How is the South African economy going to take this?
Well, fortunately, it's only a 25 basis points increase, and rates are still only at 6%. So, given all the problems and challenges that the economy is facing, it's probably not going to make too much of a difference. The Reserve Bank, though, clearly does not have the luxury of cutting interest rates to try and stimulate our economy, which is something that most central bankers around the world have been doing recently. We're in this bind of weak growth, increasing inflation, and needing to attract capital inflows. So the bank needed to raise rates to keep its credibility intact. It is, after all, an inflation-fighting central bank. But it's not going to help the consumer who is already taking on more debt, and it's not going to help economic growth. But really, that isn't the priority of the bank at this moment. Its priority is to send a credible message that it is concerned that inflation for the next 2 years is flirting with the upper 6% band. And it needs to send some kind of message that it's not going to get behind the curve when the US raises interest rates. So all in all, we think it was necessary for it to raise rates today.
So you think it was a good idea for the South African Reserve Bank to be ahead of the curve when it comes to raising rates, ahead of the United States? Because for a while, I think we were kind of thinking that South Africa needs to wait for the US to raise the interest rates and try and catch up. But it seems like we've just decided to bite the bullet and go ahead of the curve. Is that a good idea?
I think we've got very little option. When we look at us amongst other emerging markets, we look very vulnerable. A lot of our fundamentals have deteriorated. We needed to raise rates. If anything, the US is arguably getting behind the curve a bit. Yellen has been quite a dovish Federal Reserve chairman. Ben Bernanke obviously was very concerned about the 1930s depression kind of environment unfolding. So, there's a risk the Fed is behind the curve. And although the market's expecting it to only to raise rates in September and only expecting a gradual interest rate increase, there is an argument to be made that it might need to raise rates more aggressively than anybody's assuming. And that's certainly been a concern that we've had for quite a time, that the Fed will need to raise rates more aggressively than the market is pricing in. So any rate hikes that the South African Reserve Bank does, in anticipation of that, does help us.
So the Fed may be behind the curve, but one thing that we know for sure is the fact that they will start raising rates at some point. And when they do, that is likely to rattle the markets, isn't it?
We think so, although the Fed is obviously trying to minimize that risk. So you will have noticed all its communications has been about it will be patient, it will be gradual, it will be appropriate, the interest rate increases. But there's no getting around the fact that since 2009, the world has got used to zero interest rates in the US and many other economies, massive quantitative easing. There's been a lot of liquidity flowing around the world, which has inflated a lot of asset classes. So, we do think that the normalization of interest rates will be challenging for the pricing of financial assets, and it's likely to be a more difficult environment for everybody.
Let's talk about the South African economy a little bit here. So the first quarter, or rather the first half of the year, is out of the way. What were some of the highlights that we can look at and say these are the things that are likely to push or either pull the South African economy going forward?
It's hard to find highlights. Perhaps we only had 25 basis points increases so far this year. That, in a sense, is a highlight because our economy is weak. And had the Reserve Bank been forced to raise rates more aggressively, it might have looked worse. A lot of the reason we've only had 25 basis points highlight is we had this oil windfall with the oil price falling dramatically towards the end of last year. We haven't had any ratings downgrades this year, which has been a concern of the market. That's also been a highlight. But notwithstanding both those points, it's been a pretty difficult year for us. Eskom load shedding has wreaked havoc in our economy. I think with our first quarter GDP numbers, we saw the load shedding really hurt the manufacturing sector. It lopped off at least 0.5% of GDP growth. We only grew at 1.3% in the first quarter. So our consumer and business confidences are both low. Our consumer debt has started to increase again. So it's hard to get positive about our economy. It looks like it's in a really tight spot. And certainly in the performance of the equity market and the performance of shares which are more geared to economic growth, they've done particularly poorly. Outside of South African economy, the global economies also struggled to grow strongly. So, pre-2008, pre-financial crisis, we benefited from above-trend growth from most of the world. Well, that's now been a headwind. Global growth has continually disappointed. US growth was particularly weak in the first quarter, but Chinese growth, emerging market growth, everything is slowing down. So South Africa has also suffered because of that. We've self-inflicted quite a bit of that, but we've also found it hard in this global economy to get any kind of tailwinds. And, that's reflected with very depressed commodity prices. That's reflected with very weak export growth.
Our financial market has also been quite adventurous over the last few months. There's been ups and downs. There's been a lot of uncertainty. And I think with the interest rates now in South Africa being raised by 25 basis points, there's likely to be further risks within our financial markets. Are there any risks that you can sort of highlight?
Well, the market was expecting this 25 basis point increase, so it shouldn't have too much effect. It should have been priced in. But more broadly speaking, a lot of assets have benefited from interest rates being kept so low. So we've seen property counters and we've seen defensive equity shares really trading on very high multiples. Now, as cash rates become more attractive because interest rates increase, we think that this trade is going to come under pressure. It's hard, though, to see the catalyst for the cyclical shares, the cyclical resource shares to do well while global growth remains so weak. But these things are very difficult to time, and the global economy people will look back in 6 months and say, actually, it was a lot better than we expected. Those shares should then benefit from that. So, the managers we use are being quite careful about buying resource shares, but they are definitely feeling that there's more valuation or attractive valuations in those particular counters. And if investors are able to take a sort of medium-term view, I think that's the place where you're more likely to be able to generate returns going forward.
So global growth is slow. South Africa's growth is subdued. Interest rates have just started going up in South Africa. We're expecting interest rates to go up in the US. There is so much uncertainty that investors should almost be expecting over the next while, and their portfolios obviously need to be positioned well to stomach and accommodate for this uncertainty. How have we positioned our PPS portfolios to ensure that our investors are protected from the downside and are able to try and stomach, if you will, all these risks that are happening in South Africa and obviously abroad?
So there's that question is it's easy to answer the question in two parts. The first part is, with our multi-manager approach, we acknowledge that the future is uncertain and one is never sure exactly how it will pan out. So our portfolios are deliberately diversified across a number of different asset classes or managers to try to enable us to do well regardless of the situation that materializes. So that, that's an important point about a multi-managed portfolio. We're not taking an extreme position in anything because the world might turn out differently from what one expects. Having said that, though, it's clear from where we stand today that the market is at an extreme in terms of the valuations and in terms of where interest rates are. So our portfolios have been underweight equities for a number of quarters now and overweight shorter dated fixed interest assets. And we think that's a sensible way to position the portfolios at the moment. We've also been very deliberate about maximizing our offshore exposure in our Regulation 28 fund of funds. And we've continued to hold maximum exposure there despite the rand looking very weak. So we've positioned the portfolios to continue to benefit from a weakening rand, and we positioned the portfolios to try to protect in the event that interest rates are hiked further. And finally, the point I think that we've also done is we've relied quite strongly on managers to construct portfolios. So we haven't told them they need to look like the benchmark or hold shares that are big in the benchmark. We've tried to give them as much discretion as we can in order to find opportunities that they think over the next 5 to 10 years will work out. And maybe the most important thing with that is to be patient with the manager. If you still believe the manager is following their process and is constructing a sensible portfolio, one needs to stick with that manager even if it goes through short-term underperformance. So we found a lot of equity managers, for example, have underperformed markets recently as momentum-driven shares have become really expensive, we need to look past that short-term noise and understand how they're investing on behalf of their clients. And appreciate that these managers have gone through a number of cycles before where they've gone through periods of short-term underperformance.
For more on this, please grab our latest issue of Talking Points or log on to www.ppsinvestments.co.za.